My name is Kristin from Justine Peterson. We're a nonprofit organization. We're located over on South Grand by the VA hospital. And just a little background about what we do. We have three main programs, and one is credit building, which I'm going to talk to you about today, something that I've worked for the last 8 years in learning about credit reports, credit scores, mainly on the personal side. I know a little bit about business banking, but I'm really going to focus today about credit building on the personal side. We work with individuals one-on-one, so our counseling is all done one-on-one. We have a client come in, we sit down with them, we look at their credit report, we pull a credit report and their credit scores, and then we talk to them about their banking practices. We do a budget on every client, savings practices, and then really look at the credit. And we believe credit is really a financial asset for businesses and for on the personal side as well. Our two other programs that we have at Justine Peterson, we're a HUD certified counseling agency, so we do help individuals to purchase houses, go through that pre-purchase counseling in order to get a mortgage loan, either as a first time or refinance or buy a second house. So we do that. And then our third, which most of you are probably going to be very interested or are very interested, is we are a micro lender. We're an SBA intermediary where we can lend up to a certain amount, usually under $10,000 through the SBA. We're also a CDFI, a community development financial institution, in which we can lend up to about $50,000. And then we also have a contractor loan fund in which we can lend up to $150,000. And I can probably talk a little bit about that in our Q&A, although that is not my expertise, but I do know we'll be able to give you some information about our lending operations that go on. I'm going to talk about credit building, and as Sandra talked about, and I'm sorry, I don't really like to stand behind podiums, so I'm going to move out just a little bit. Credit building is really important. We believe it's really one of the #1 financial assets, especially for a small business. In order for you to get, many of you will need or do access loan capital for your business, and that is very important. And the first thing that a banker is going to look at is those numbers that David talked about. And one of those numbers that they're going to look at is your FICO credit score, right? And that's really what we see as part of the whole package when it comes to a small business. Sandra also talked about, for many of you, you might have great credit scores, great personal credit scores, and you're now building a business credit score, right, through Dun & Bradstreet or with a Dunn's number. But your employees, and you have employees that come to you, and they're accessing funds at higher interest rates. They're getting car loans at higher interest rates, which is reducing the income that's coming into their budget, right? So it's creating more expenses, and it's becoming a hardship. And when hardships happen in finances, especially on the personal level, then there can be decrease in coming to work because the car is breaking down and they don't have the funds to fix the car. There's a lot of issues that come when our expenses are exceeding the income that's coming in. So we believe credit building is really important, and we believe that having a good credit score is really important. And one of the scenario that I give and why credit is so expensive or so important is really in the process of, if you do, let's say you have a car loan, and let's say it's a $10,000 car loan at a 5-year interest rate or 5-year term, and if you have a low credit score, you're going to pay probably about 24% interest rate in the state of Missouri. And that car loan at $10,000 is going to cost that individual $294 a month. Their loan payment would be $294 a month. And over 5 years, they'll end up paying $7,611 in interest alone. So that car that was worth $10,000 now costs $17,611. If they get a good car loan, they have a good credit score, and they're able to get an interest rate at a good rate, they could maybe get a 5%. It goes down to probably about 2.5% on a used car. But at a 5%, you're looking at $189 a month. That's $100 saving that either yourself or one of your employees could save just in this one car loan product. And that's over the interest on the 5-year 5% interest rate would be $1,323. Over $6,000 that person is saving over 5 years. That is a lot of money, right? That's a lot of money that's just going to this one car product. We also see that car insurance is based on your credit score, on your personal credit score. So you could be paying higher premium on your car insurance because your credit score is lower. And we typically see that your car insurance premium is double when you have a lower credit score. So that person who has a car loan and has car insurance is probably paying anywhere from $150 to $200 extra a month just because of their credit report and their credit score. And this is really, really hurts the personal budget. Right? And so that's why credit is so important. And credit's not just about getting loans, it's also about just basic financial stability. The ability to get a bank account can sometimes be based on your credit report, your score. The ability to rent an apartment is based on your credit report, your score. We actually see that where an individual lives is really more based on their credit report and their score than their income. Because if they could have a really high income but a really low credit score and not be able to rent in an area that they want. So they have to go to an area in which a landlord's more willing to take risks, right? So a credit score, a credit report is very important, having a good score and good report. And we can help with that at Justine Peterson. A couple other points that I want to point out is that how do we build credit? And it's really simple. Many of our clients come in and they think that we're going to talk about debt. So your employees or maybe even yourself, you might have some bad debt that's out there. Your credit report, your credit scores, the good thing about it is that it's all about what you're doing now, not what you did in the past. So if you did have some negative things, in the past 2 years, and it's still on your report because unfortunately that stuff stays on for 7 years, if it's still on your report, it's okay. The score is elastic. The score can show, if you start showing that you can manage your credit now, your score can start to increase, okay? And you can have a decent score with still having kind of this old bad stuff on there. And so we do what's called credit building, which is the act of getting 1 or 2 or maybe up to 3 good lines of credit going. And you don't have to be in a lot of debt in order to build credit. Just small lines, a $300 loan, a $1,000 loan, will help to build your credit score and get to a place where you can access better financing and rent an apartment and get non-predatory products. And we do this with small lines. The other steps in building credit is going to be really managing your debt really well that is on your credit report, making sure you're paying on time. A 30-day late can bring a score down 100 points. So it's really important that when you do access a good line of credit, that and it's reported on your personal credit report, that you're making sure that those payments are on time. And then credit cards. And this is really important, especially for small businesses. We see a lot of small businesses financing their business on credit cards. What really hurts the score is when we max out credit cards. So if you have a credit line of $1,000 and you have a balance of $1,000, your score can be brought down because of that, somewhere anywhere from 30 to 40 points, because you have a maxed out credit card and you're looking like you're a high risk to the score modelers. Usually FICO is what we're talking about, the FICO score. And so keeping your balances under 30% is what optimizes your credit score. So if I see a business that comes to me and they say, I've been denied a business loan due to my personal credit, and they might have a decent score, maybe a 660 or 680, but I see credit cards on there and they're all maxed out and they want to know how to bring their score up. As long as they're paying on time, we're going to really start talking about decreasing the credit card balances, because that's a really big impact on the score, is that when they're above this 30, even 50%, 30 is best, 50% is okay, but the 30% threshold of utilizing their balances, then that really decreases their credit score. And so this is really how we work on building credit. It's not about the debt. People can come in, they might have collection debt, but we really want to get that good stuff going, because like I said, the score is all about what you're doing now and not what you did in the past. Once we kind of get the good stuff going and people are paying on time, we then work on paying off the old stuff, the collections debt. We look at the statute of limitations, when it's going to fall off. We look at the legality of it. Is it actually legal debt? We do dispute letters. We see that 25% of individuals or consumers have inaccurate information on their credit report, and that a consumer can really engage in their credit report and dispute that information without hiring somebody to do that. So there's companies out there that I have clients that are that are paying $99 a month to dispute everything on their credit report. Since we're a lender, we actually get some of those disputes, and I've kind of engaged in some of that activity of these dispute letters, but they're really, the letters that I'm getting from these companies in which they're disputing everything off the credit report don't even make sense, and they're not even legal. I don't even technically have to comply with them because the way that they've addressed them. And so it's really important as a consumer to understand what's on your credit report, what's accurate, what's inaccurate, and for yourself to really be part of that. David talked a lot about relationships and managing your relationships, and one of those relationships you have to manage is those with the credit bureaus. A consumer has to be fully involved in their credit report because that information is being reported by you. It's being reported for you, and you want to make sure that that information is accurate, which it's not always. Let me see if there's, I think that's kind of my spiel that I was going to talk about. Just some resources, either for yourself or for your employees, whether they're interested in building credit or just understanding what's on their credit report. A great place to go to is annualcreditreport.com, in which consumers get a free credit report once a year from each of the 3 credit bureaus. You don't get a score, you have to pay for your score, and it's not a true FICO score. But annual credit report, if you are looking for resources for your clients, that's a great place to go. Although if they come to us and see us for counseling purposes, we'll pull that report and that score and go over it one-on-one with the client. Sandra also talked about kind of banking and getting individuals set up on, if you're going to turn over to direct deposit and your employees aren't able to get a bank account, we're able to help with that. We work with many financial institutions that have second chance checking accounts or prepaid debit cards, something in which employees can then get an account and get that paycheck direct deposited. So I think I'll end there.